What's going on, traders? It's Ricky with Technical Solutions. So thank you guys again for joining us for another helpful video. I do want to let you guys know that the reason that I'm making this video is due to one of our members. His name's Steven. He asked for me to make a video based on this specific topic. If you guys want me to make any video on any questions that you guys have, we already do have a series of frequently asked questions, and they're all under the helpful video playlist, so feel free to navigate through that. And if there's not a video that I've made already on this specific topic, feel free to comment down below. I will be looking at the comments and then just request any video that you would like me to make to elaborate a little bit more on, a best practice that I've had, or explaining something when it comes down to trading or investing altogether. The reason that I'm actually making this video, like I said, Steven, I jumped on a one-to-one video call, which is a consultation call that I now offer. The link is provided for you down in the description. If you did not know that I do jump on one-to-one video calls already, feel free to check it out. So let's go ahead and jump on to what is a trailing stop. So I do want to let you guys know that there is not a trailing stop order type available in every brokerage company. If you guys that are using Robinhood might be like, well, what the heck, that's not under the list of my order types within the Robinhood platform. Well, that's simply because Robinhood does not offer that specific order type. TD Ameritrade and Fidelity both offer that order type. It's those two brokerage companies are ones that I'm personally using. I use TD Ameritrade Thinkorswim platform to be able to see and view real-time quotes, and then I use Fidelity for my actual executions when it comes down to me buying and selling different stocks. And I know both of them do offer that specific feature. So what is a trailing stop loss? Well, I'm gonna explain to you in this video on how I've been able to in a sense use it based on my experience, but in no way does this mean that this is the only way that you guys can use it. Again, you want to make sure that you dedicate your own DD before you do anything. Again, we don't invest in what we don't understand. We never invest based on anyone else's opinion, and we always have a plan when trading. So I hope you guys enjoyed today's video. I'm going to be explaining how a trailing stop works. So pretty much what a trailing stop is, it allows you to not have a real limit on the amount of profit that you've already made. So what I mean by that is, well, I think I should probably just jump into kind of like the animation. I'm gonna do it with like some pens and papers. I think it's gonna be very easy, but hopefully it's easy to understand. So I hope you guys enjoy. All right, traders. So a trailing stop loss, just to provide you kind of like a definition on what it is, will allow you to automatically sell your position at a difference of where it peaked out at during market price and the cushion you give it. So the whole point of a trailing stop loss is wherever it peaks out at. So like, let's say you bought in down here at $60.10. So let's say you bought in at 60.50, whatever. Okay, so 60.50. You've already built this margin of profit, so the market opens and it hits highs of $63.32. Therefore, because you already have this huge margin for profit, or this decent margin of profit of 4.75%, you don't want to give too much of that margin up. But because JDST still has the potential to trend back up to $70, you want to give it that cushion for it to move around without automatically selling your position, and then you don't want to dedicate all that time to just continue watching the stock. So again, this is why people usually use this certain order type to swing trade and not to day trade. Usually if you're day trading, you're there actively watching it and giving it that cushion, and then once it breaks the trend, you could automatically sell. What JDST allows you to do is for a swing trade, long term, for a series of days, it will allow it to give it that cushion for it to move around once you're already in the green. Therefore, if you bought in at $60.50 and once it breaks like at $64, you already have this huge margin of profit, that because you have such a huge margin of profit, you're willing to set a trailing stop loss at a difference of $2, meaning that you will give wherever the price is at a $2 like cushion for it to move around before it automatically sells your position. Therefore, there is no limit on where your position will automatically sell, because you're giving it that cushion for it to continue moving up and down of $2 from where it peaks out at, and giving it a $2 cushion to move down before it can bounce back up before it sells. And if it exceeds $2, then it will sell your position automatically at a market order, meaning that it will automatically sell your position at whatever the market price is once it exceeds that $2 difference. So pretty much what a trailing stop loss allows you to do is it allows you to give you that cushion for it to trend up throughout a series of days without you having to follow this specific stock. So what's an approach that you can take when it comes down to using a trailing stop loss? The whole point of a trailing stop loss is to give it a cushion big enough for it to move around, for it to hit its overall resistance, and then for you to sell a profit, right? That's the overall point of a trailing stop loss, to be able to give it that movement or that margin for it to move around without filling until it hits, the resistance where you can, cancel that trailing stop loss and then put in a limit order to sell at the resistance at $70. To identify what margin or what number for the trailing stop loss you have to set to make sure that you give it enough cushion to move around. So today from lows to highs, it moved around from lows of, what is that, $61.21 to highs of almost, $63.50. Therefore, there's more than a $2 margin that this stock moved around today. Therefore, when it peaked out at, if it dropped below and it moved lower than $2 from where it peaked out at, it would have automatically sold your position and you would have locked in profits from $60.50 to, wherever it is that it's sold. So that means that your margin or your trailing stop loss was too tight, that it didn't give it that margin to move up and to continue its trend upward. Therefore, something that you need to identify is what's the largest margin that it moves around within a day. Therefore, that is the margin that you should set to give it that cushion to move around. So today was a little bit over $2. Tomorrow it might be $1. And then the following day might be $3. Well, understand that if you're trending and you're wanting to sell at $70 and you wanted to give it that margin to move around, you have to give it the largest margin to not sell automatically. Meaning that if the largest margin where it moves around within one day is $3, then you have to give it a $3 trailing stop loss margin so it can move around within a $3 margin and not, sell at market price and not sell your positions. So the whole point of a trailing stop loss is to give it cushion to move around, but to automatically sell your position if it breaks that margin or that, margin that you set, that if it breaks that, $2 margin or that $3 margin, that it will automatically sell your position. I know that can be somewhat confusing, but again, it's the whole point of a trailing stop loss is to give it cushion to continue trending upward. Alright guys, and I know that can be somewhat confusing, but again, just to kind of recap on what a trailing stop loss is, it allows you to set a specific order type that if you're already up and green on a trade, you can set a trailing stop loss to give it a cushion for it to continue moving up and down and continue its upward trend without you having to sell with an order type and without you having to really watch it. And then once it hits a certain point, then you can remove that trailing stop loss and then sell out a limit order. The reason that there's this margin that you have to identify yourself and that you have to set yourself to be successful is some stocks move around 5 cents to 10 cents every day, and it's usually the margin that they make up. If it breaks that 10-cent margin, right, if it breaks like 20 cents, then it breaks that trend and then you're most likely going to want to sell your position. So the whole point of a trailing stop loss is to identify the average, if not the greatest margin that it moves around within one day, and then set that as your trailing stop loss, because you want to make sure that you allow it to give it that movement before you sell your position at market price and then lock in those profits. You want to make sure that it's something that makes sense to you and that you lock in profits at wherever it is that you want to set. But a trailing stop loss can be extremely useful for someone that is swing trading and that identified a support and a resistance and that's already green on the trade but thinks that it can continue trending back up. Therefore, if you set a trailing stop loss of $1.50, it will give it a $1.50 margin to move around. Therefore, once it hits that overall resistance that you've identified, you can automatically sell that position, and it will allow you to at least have like an exit point in case it breaks that $1.50 trend. So again, the whole point of a trailing stop loss is to allow your position that's already in the green to have a cushion to move around and can continue trending upward. But once it breaks that trend, it will automatically sell your position. Or, according to your plan, once it hits that overall resistance that you've identified, then you could remove your trailing stop loss, which is pretty much just a safety net to at least capture some of the profits that you've already made and then lock in those profits. So then you can remove that trailing stop loss, set a limit order at the overall resistance that you've been working towards, and then sell your position from kind of like JDST. JDST has a support at $60, resistance at $70. A lot of people that are swing trading that use a trailing stop loss and might give it a $2 to $3 profit, $2 to $3 margin for it to move around. Therefore, it could successfully move around and have the proper margin to approach and end up achieving that $70 price point. So there's an approach that you can use it for day trading as well. Obviously, you're going to want to keep those margins potentially a little bit tighter if that makes sense to you. But just know that if you keep a tighter trailing stop, then you might end up, having your position filled a little bit quicker than others. But if you end up keeping a more open trailing stop, then you're also giving away more potential profit that you've already made. Therefore, it's however your approach may be. So with the trailing stop loss, you want to identify a margin for profit that the stock usually experiences, and then if it breaks that trend, then it'll automatically sell your position at the market price. So I hope this helped you guys out when it came down to explaining and elaborating a little bit more on what a trailing stop loss is. Again, it is an order type that is available for certain brokerage companies, not all of them, and it's something that I have successfully used when it comes down to swing trading and also day trading, because if you identify the average margin of profit or just average margin that a stock usually moves up on an upward trend, then you can set that as your trailing stop loss. Therefore, since you're already in the green, you're at least giving it more cushion because you still think that there's more potential, but you're also making sure that all of a sudden if it breaks that trend, then you lock in the profits that you've already made. Again, so a trailing stop loss, based on what I use it for, is once you are already in the green and you think that it still has more margin for profit, you set a trailing stop loss at the greatest margin that it moves within 1 day, therefore giving it that margin to continue trending upwards. And if it breaks that margin, let's say it's a $2 margin, then it will automatically sell your position and lock in the profits that you've already made. But the whole point of a trailing stop loss is to give it that proper margin or cushion to trend back up to its overall resistance, where then you can cancel the trailing stop loss and then end up putting a limit order or a market order to sell your position at your desired sell point. So something like JDST, buying it at $60, giving it the proper margin for it to trend up to $70 without having to automatically sell that position or lock in profits when you know that there's still more potential profit to be made. So I hope this video explained to you guys what a trailing stop loss is. If you guys have any questions, please leave them down in the comments. Again, I do have a group, it's TechBud Solutions. We are a little bit now over 38,500 members worldwide. And the thing that we do best is we provide a clear and simple platform for both new and experienced traders. If you guys would like to be a part of our community, you simply have to have a Facebook group. Please feel free to click the link down below. And if you guys do not follow me in any of my social media accounts, again, my Instagram and all that for TechBuds and my personal are provided for you down below. Thank you again for everything it is that you guys do. Continue working hard, continue following your dreams, and let your passion be what drives your success. Like always, guys, let's make sure that we end the year on a green note. Take care, guys.